And with that, we are ready to begin today's event, once again sponsored by Secure Key and hosted by American Banker. It's my pleasure to introduce your moderator for today, and that is Michael Sisk. Mike, you have the floor.
Thank you very much, Greg, and I'd like to welcome the audience once again. We are grateful you've chosen to share some of your day with us. We know that your time is valuable, and we will honor that today with what I am confident is going to be an engaging 60 minutes or so of discussion. Once again, our topic today is Banking 2020, mCommerce, Virtual Money, and Privacy. Are you ready? My name is Michael Sisk. I will be your moderator today. I've been a New York-based journalist for about 15 years with stints as editor-at-large at American Banker and contributing editor at Bank Technology News. My articles have appeared in Barron's, Crane's New York Business, Institutional Investor, Strategy in Business and Worth, and I have co-written and edited several books. The most recent was Merge Ahead, Mastering the 5 Enduring Trends of Artful M&A. That's me, but more importantly, we have a number of expert panelists today that I would like to introduce you to now. The first is Michael Ting. Prior to joining Secure Key as VP of Payments, Michael was the head of payment services at Odesk since 2010, the leading online workplace, where he oversaw in excess of $450 million in annual payment volume. He directed all payment strategies and product initiatives while leading business development efforts with financial institutions and payment processing partners. Prior to Odesk, Michael was Director of Online Products at OboPay, a global firm providing comprehensive solutions within the mobile payment space. He was also an early member of the PayPal team as Director of Financial Services from 2000 until the company's acquisition by eBay in 2002. Michael is an advisor to YeePay, a leading China-based payments company. He received a BS in economics from the University of California, Los Angeles. Also today, we have Mark Brulé. Mark is currently the Chief Emerging Payments Officer at the Royal Canadian Mint. Prior to this recent appointment, for the past 6 years, Mark was the CFO at the Mint. For the last few years, Mark has been leading a research and development team looking into the evolution of currency. MintChip is a prototype digital cash product that is omni-channel, which will be piloted by the Mint in 2014. Mark is a chartered accountant and was a KPMG partner for some 20 years prior to joining the Mint. Also, we have Vishram Dalvi. He is Director of Strategy and helps figure out how Intel identity protection technology can solve the pain points of market segments like e-commerce, payments, banking, enterprise, government, and healthcare, and leads the business expansion in these areas. He has over 20 years of broad experience in strategy, business development, marketing, management, and VLSI design. He has worked extensively with key players in the PC, mobile phone, e-commerce, payments, security, internet, and location-based services markets in U.S., Europe, APAC, and Japan. He is a Wharton MBA and a UT Austin ECE graduate. He speaks Hindi, Japanese, and basic Mandarin Chinese. All right, rounding out our group today is Bruce Parker. Bruce has been a payments geek for the better part of a decade, beginning with S2 Systems in 2002, followed by eFunds and ACI worldwide. Bruce has worked on new products, partners, and strategy for the leading providers in the payments technology space. He also has had the privilege of working with some of the largest financial institutions and payments providers in the world at FIS, bringing new solutions to the payments marketplace. Bruce has gotten bitten by the startup bug and founded a mobile payments concern in 2010, now known as Modo Payments. So that is our crew today, and we are very honored to have them all here. Once again, the topic today, Banking 2020, mCommerce, Virtual Money, and Privacy. Are you ready? And let me just take us quickly through the agenda today. We've obviously just done the welcome and introductions. The first section of our agenda today will be the landscape today and the future that Michael Ting will speak about. We will also have the evolution of currencies from Mark Brulé, the need for better online authentication from Vishram, and then making mobile payments happen with the stuff everyone has by Bruce. And then after those four, we will have a Q&A, usually runs about 10 minutes at the end. We encourage everyone to enter your questions in the console here as they occur to you, and we will get to everyone's questions in the time that we have left. And anyone's questions that we don't get to, there's always follow-up afterwards. So your voice will be heard and your question will be answered. So please just feel free to put in anything that occurs to you. And finally, there will be one poll question at the very end, and we just ask you to participate that if you would. That'll be kind of running concurrently with the Q&A. And So your participation would be much appreciated. And with that, I think I'm done with my introductory spiel, and I will turn things over to Michael. Michael, you have the floor.
Great. Thanks very much, Mike. Thank you, everybody. To start, I think that in order for us to actually discuss digital and virtual currencies and why we think they're necessary, it's very important for us to talk about them in the context of something we're familiar with every day, which is, of course, cold hard cash. When we think about cash, the adage, cash is king, continues to hold true. Why is that the case? Well, for starters, it's ubiquitous. A sender and receiver can use it anywhere. Neither has to worry about whether the other one is actually part of the same so-called network. It's anonymous, so my private financial behavior and information about myself remains mine. And it's reliable. I know it works, and it remains the only instant guaranteed form of payment for merchants. The cash is also, from a convenience standpoint, a bit clumsy. I have to continue to replenish it, either by going to an ATM or going to a branch. And if I lose it, it's gone. I can't really recover it. But eventually, cash eventually went digital or electronic. And some might say it happened with the advent of payment cards, and then further on down the line with services like PayPal and the plethora of digital wallets that we're starting to see come up. And while those solved for many of the convenience and efficiency problems of cash, they completely changed the privacy framework around payment. Use money and information associated with that behavior was no longer yours and yours only. So fast forward a little bit, and now we're starting to talk about what we're calling virtual currencies, which are really value mediums that are substitutes for real money. And when we think about virtual currencies, particularly if you've been paying attention to the news over the last 12 months, we instantly think about Bitcoin. And for those of us who are not computer nerds or enthusiasts or speculators, and for a lot of us who've actually never even really grasped the concept around Bitcoin, for a lot of us we say, okay, well, virtual currency is probably a little outside my domain and probably doesn't apply to me. But think about that a little bit more. We use travel rewards every day. Gaming credits to be able to use points to play and buy things within a virtual economy, within any one of the games that you see online. At one point, Facebook issued their own virtual currency called Facebook Credit. And some might even say that the good old-fashioned coupon was even a form of virtual currency. So the point is that virtual currencies are very much a part of our lives. But the virtual currencies that we've been using have been very limited to sort of closed-loop private systems run by merchants and other brand-name companies. But how do we deliver a virtual currency that holds similar privacy merits and guarantees cash? And I'm going to allow our friends at the Canadian Mint to talk about that a little bit more in a few minutes. So why do we think that it's an important topic now? Why do we think it's different now? Well, the emergence of enabling technologies, both on the consumer side and the merchant side, particularly mobile devices, has increased the utility of these currencies. Mobile enables these currencies to be used in a very similar manner to cash, anytime, anywhere. We used to be limited to using these currencies at home or on a computer, and now we're able to mobile enables merchants to issue loyalty currency quickly and easily, and it allows those consumers to redeem it just as easily. It also enables consumers to carry and manage infinite types of currencies inside virtual wallets or mobile wallets, which is not possible before mobile technology, nor was the ability to conduct regular commerce in both online and physical environments, much in the way we live our daily lives with cash. So in many ways, we could say that virtual currencies, and one that actually provides the same merits and guarantees cash, coupled with mobile technology, could be a catalyst for mobile payment mobile payments adoption. We've all heard about the so-called mobile payment tipping point that over the last several years keeps getting pushed out further and further, and this could definitely be a contributing piece to that. So in the end, we think that the participants can be able to behave in the way they naturally do today with the combination of mobile and virtual currency. But with all that said, this new environment, of course, creates a whole new set of challenges, particularly around security and identity and authentication. So where does that lead us? Well, this intersection of new currencies and mobile technologies obviously raises a number of questions. Chief among them is, what problems do these currencies really solve? We touched on them a little bit, and I'll let Mark talk about that a little bit more. How does a consumer actually acquire virtual currency? And how does a merchant accept the virtual currency so that they can be used in very similar ways that we conduct commerce today? What are the triggers that we think are going to actually lead to adoption of mobile payments, and in what ways do we think it can actually be a catalyst for mobile payment usage? And on the risk side, what are the security and risk implications? And what is the regulatory framework going to look like? And all these questions, I think, are going to be covered by my peers on the panel. And with that, we'll hand it off to Mark.
Thank you, Michael, and good afternoon, everyone. And before going into the next slide, I think it's perhaps useful just to give a bit of background on the Canadian Mint, if I may. And we are a Crown corporation in Canada, and we produce the coinage for Canada as well as many other countries. But part of what we've been doing under an R&D project that we've branded Mint Chip is really looking at what we envision being the evolution of currency. And why we started looking at that, many people ask in terms of a mint. Well, producing coins, as things start to change, people start to change their spending habits and how they transact. And in fact, as Michael mentioned earlier, mobile is a game changer, we believe. And there's a confluence of, social payments, e-commerce, and one of the terms up on this slide that I'm quite fond of is the one called the digital native. And when I talk to my executives at the Mint, I say to them, don't think of yourself as the primary users of a virtual currency, but think in terms of a digital native. And most of us have children, and I like to use my 25-year-old son who doesn't live at home, doesn't have a landline, doesn't wear a watch, doesn't own a camera, doesn't have an alarm clock, but he certainly does have a smartphone. And he lives by that phone, and we believe that virtual currencies that will embrace mobile is the way to go. So when you think about virtual currencies and the emergence of them, you really can't speak of them today without speaking about Bitcoin and how Bitcoin really has elevated the profile of virtual currencies. Speaking for ourselves here at the Mint, we started our Mint Chip project, as I say, 4 to 5 years ago, and really, with the advent of Bitcoin in the last 12 months or so, it has certainly raised the awareness and the discussion, and probably many of us have seen the IRS ruling in the U.S. that came out earlier this week. But I think the time for virtual currencies is very prime. We're in a 21st century situation with new technologies, and the merchants and consumers, I believe, are looking for more relevant payment solutions, as it says here, for the changing market needs. And what that means is merchants have long, for some time now, been concerned about the rising cost of accepting credit card payments. And they are becoming more active, as it says here, in that process and examining ways of how they might be more cost-effective in processing payments. And as an example, in the United States, there's an entity now that's been set up called MCX, Merchant Consumer Exchange, by many of the very large merchants in the U.S. to in fact look into this question exactly. One of the other things that we believe, one of the other premises is that if you look at the payment technologies today and you think about them in an e-commerce sense, when you get down to what we call micro or nano type of payments, and we look at those as payments below $10 or even $5, and nano when you get down into payments or goods or services for less than a couple of dollars, the current payment technologies really do not measure up very well for those kinds of services or products and become almost cost prohibitive. But think about media maybe selling their content by the article as opposed to trying to sell their content by a subscription model on a monthly basis. And if you look at P2P payments, I think virtual currencies and mCommerce in particular are very adept at doing cost-effective and efficient P2P payments. And when you look at where I think virtual currencies have a natural landing place, it's probably in the low-value transactions where cash is still king, as mentioned earlier. And we believe merchants and consumers, through some of the research that we've done, are actually looking for a digital equivalent to cash. So if you think about what is the virtual opportunity, we believe that there's the opportunity here is to provide a more cost-efficient payment methodology for trade and commerce. Also, this virtual type of currency, or these cryptocurrencies, if you wish, really become a breakthrough technology for developing markets. We who live in a developed market have had electronic payments for some time. We've also got a very robust banking infrastructure, but if you think to the developing world where there isn't a banking infrastructure, there are very harsh environments, but they do have mobile technology, and virtual currencies are made for the mobile type of technology, and therefore can deliver a very cost-effective transaction to these developing markets. But when you look at virtual transactions, cryptography, and all the rest, I think in behind these kinds of technologies, one lies trust, and trust requires security, and secure authentication is a core requirement, we believe, behind any kind of virtual currency. And lastly, with these kinds of digital currencies, as I mentioned earlier, we believe that they are prime time for the 21st century commerce that is emerging today. So with that, perhaps now we can move over to Vishram and speak about the Intel technology. Vishram?
Yeah, hi, thank you so much. So hi, I'm Vishram Dalvi, and I'm the Director of Strategy for technology called Identity Protection Technology. This is being built by Intel into the device hardware itself, and I will talk more about it. And if any of you wish to contact me later, my email address is right here, vishrampdalvi@intel.com. And what I'm going to talk about is the need for better authentication. So we started out the discussion talking about bitcoins and virtual currencies, but in general, anytime you're talking about any kind of digital assets, whether it is online banking, whether it is e-commerce and protecting your credit cards, or whether it is even just protecting your emails and your social networking access, it becomes critically important to ensure that only the owner of those digital assets is allowed to access those assets. And if you have been looking at the newspaper just in the beginning of this year itself, we have had several incidents. We have talked about many of the top banks getting hacked. Banks are certainly getting spear phishing attacks a lot. In South Korea, 20 million, credit cards, which is half the population's credit cards, were compromised. And I'm sure you're all familiar with what happened in the Target case, in which one of the contractors, their credentials were compromised, and hackers were able to get in and be able to put malware on the mobile, point-of-sale devices. And talking about Bitcoin, the largest Bitcoin exchange, Mongo, which is based, in Tokyo, it was hacked, and they lost somewhere near $350 to $400 million worth of Bitcoin. So, having strong authentication to ensure that only the owner gets access to these technologies is critically important. And if you look at the authentication technology landscape today, I see a dichotomy. On one hand, towards the left, you will see you have strong authentication, where technologies such as one-time password tokens and smart card readers are being deployed. These are quite expensive technologies. They're also complicated, and therefore they are being deployed only where high security is absolutely essential, such as government, such as enterprise VPN, and high-value customers for banking. On the right-hand side, what I call large-scale authentication, when you log into a bank, website, or you log into Facebook or your Gmail access, they cannot afford to deploy the expensive strong authentication technologies. And what they have done instead is deploy technologies which are largely based on browser-based device ID and IP address and reverse geolocation and so on, and cookies. And these technologies are much more cheaper. They can be deployed on a larger scale without having a need for the user to be sophisticated. But also these technologies are not as secure as these other technologies on the left-hand side. So there is a gap right now where, as all our life is moving on into the cloud, there's a need for a higher strength alternative that is simple for end users to adopt and is also cost-effective for mass deployment. And this is where Intel's Identity Protection Technology, or IPT, this excels at all the metrics, and I will talk about this in just a couple more slides. So on the next slide, you're asking yourself, what exactly is this IPT technology? So the first point to emphasize is IPT is something Intel has implemented in a separate chip from the main CPU. So you have the main CPU, which is, used to be the Pentium, and now it's Core i3, i5, i7. That is where the main operating system runs, and that is where your browser will run. That's where your malware and everything else runs in that same operating system layer. What we have is a physically separate chip where we have implemented security primitives. This has its own signed firmware operating system, and so on. So what we have done with these capabilities is we have built a one-time password function. So you can generate one-time passwords in the hardware itself, and the user does not need to cut, paste anything, carry a token with them, or wait for an SMS token that then they have to enter back into the website. This is something that can be done very transparently, where your PC or your tablet or phone can just send a one-time password in hardware to the server of a bank or a social network to be able to authenticate you. The second technology is a display encryption technology, also known as Protected Transaction Display, or PTD. And what this does is it allows us to encrypt a portion of a display. So your bank may choose to show you a little PIN pad and say, please enter your PIN to log in. And what you type in there cannot be seen by malware. It looks like a black box. And this can be used for all sorts of applications, PIN pad being one of them, but even as simple as CAPTCHAs. You see the ugly, gnarly CAPTCHAs nowadays. You don't need to have those. You can have simple CAPTCHAs protected by PTD. The third technology is NFC. So we are seeing a trend towards PC OEMs, tablet OEMs starting to put contactless readers in the device. And that information we can protect with IPT so it does not get exposed to malware. And the fourth component, for those of you who are more security-minded, which is PKI, so we have put a certificate and RSA key pair technology, again, in the chipset for providing higher-level authentication. So we are working with various PC OEMs to build an installed base of these devices. And we're expecting by end of this year, we'll have somewhere close to 500 million devices. And about, in the next 2.5 years, we'll have over 1 billion devices worldwide that have these technologies built in. And then we're also working with security software vendors, such as SecureKey, to have services on these technologies available worldwide. So you can see that IPT provides a very strong suite of online security blocks. Now, what is really important when you talk about better authentication is to not only provide higher security, but also balance what is the cost of the solution and what is the ease of use. Because if it is not easy, then it will not get deployed. If it's expensive, it will not get deployed. So IPT, as I mentioned earlier, is built in a separate chip. And therefore, because of what we do, it is able to defend against, man-in-the-middle, man-in-the-browser attacks. It is protected from regular keystroke loggers. It proves you that there is a user physically present in front of the device. So it's not a bot-initiated transaction. And if you have, God forbid, a hack, such as what happened 3 years ago with RSA, you could do remote revocation and reprovisioning of those tokens immediately. Because it is built in the hardware itself, there is no manufacturing cost, there is no provisioning cost, and in the case of SMS tokens, there is a per transaction cost. To send the SMS, you will not incur that cost for using IPT. And the ease of use, this can be done in a way that is transparent to the end user, so the user behavior doesn't have to change. They don't need to carry a phone, wait for an SMS token, enter it in there. Or if they have a hardware token, there are no concerns about losing or forgetting a token. So IPT addresses all three of these metrics extremely well, which is higher security, lower cost, and ease of use. And we just came out with this technology in 2012, and we already have a range of solutions enabled worldwide for banking, for virtual coins, for e-commerce, and so on and so forth. And SecureKey is one of our key partners in this area, and they are working with various sectors here, in the banking arena, in the government arena, and so on and so forth, to make these IPT-enabled solutions available worldwide. So with that, this is the end, so I hand over to the next speaker.
Great. Thanks, Bishram. This is Bruce Parker. I saw that you got a couple questions there. Maybe you can swing back around to those folks as we continue to move through the prepared materials, and I know that we've got some Q&A coming up.
Okay.
With respect to Moto, very briefly, we have sort of a point of view about mobile payments that we really have to start from the presumption of using the equipment that's in place, the infrastructure that's in place, and the networks that's in place. We'll come back to that in just a moment. I think when we started the discussion here today, there was a reference to the fact that perhaps this is the year of mobile payments, and having been in this space for a little while, I can tell you that I've heard that expression just about every year for the last 10. So I do actually think that things are very, very different now than they were a decade ago. But I do also think that there's a couple of key dynamics that's very important to note as to why mobile payments haven't gotten the level of adoption and the level of widespread use that we all sort of are all convinced are going to happen. And I think actually that's one of the root issues. The root issue is the fact that everybody understands why mobile payments are important. Everybody understands what controlling that last mile connection between a customer and a purchase really could mean, both in terms of an opportunity if you're a vendor in this space, as well as a critical threat if you're somebody who's already got a very large franchise. So at the end of the day, the way that we've kind of looked at this space and thought about what's really going on, or what are some of the underlying challenges here, is precisely this issue of everyone wanting to control, whether they think of it as a toll gate, whether they think of it as an opportunity for disruption, or they think of it as a threat for that disruption to happen to them. And we've kind of broken it up into this quadrant that you can see. From a new entrants perspective, obviously, they're looking to capture some new revenues and monetize their existing behaviors, existing audiences in general. And they can be either somebody who's been around from a long perspective, from a carrier's standpoint. Obviously, they've got great relationship with customers. Or they could be a tech titan. And the tech titan is actually entering into the payment space with kind of not really a relationship with the consumer, but a number of interactions that they've been having with them for a long time. And incumbents meaning incumbents to the payment space today, generally speaking, are looking to protect revenues and improve margins. There was a reference earlier to MCX. We'll talk a little bit more about them in just a moment. But banks obviously at some level have gotten, and this is unfortunate, on the wrong side of the equation from the merchants. A little bit of a history lesson. When cards were introduced in the 70s, when wide-scale adoption really started to happen and the Visa network started to take off and the MasterCard network really began to gain traction as well, the critical issue and the critical reason that merchants were excited about adopting that was the very clear, demonstrable evidence that someone paying with a card rather than cash or check, which are the only other forms that were accepted at that point, tended to spend more. It increased the average basket. So this whole ecosystem that was built around this notion of increasing the value to a merchant for a customer on a given transaction, getting merchants out of the business of extending credit, has changed radically now. And we're well past the adoption curve. We're actually in the flat part of the S-curve for those payment types that use cards and those networks. And so now what we have to do is basically go back and revisit that. So what will it take for mobile payments to take off? What's kind of the key missing ingredient, and what's the key dimension for that. I can tell you one thing that we believe strongly that it's not, and that is what we refer to as changing stuff. So stuff is all the things that are necessary, whether you're intimately familiar with this because you've been in the payment space forever, or this is a little bit of a new topic for you and you're thinking about this in terms of how it may relate to your business. The issue is this existing ecosystem, this existing infrastructure that supports our current payments environment that we know of today involves a lot of different moving parts. And those different moving parts actually are highly resistant to change. So one of the ways that we've been thinking about that is to sort of look at each of the key elements required from a mobile payments perspective and say, okay, let's say, for instance, that one of the things that you had to do in order to make mobile payments a reality is issue a new form of card or a new form of account. And I'll pick on somebody who's no longer with us, may they rest in peace, our dear friends from Bling Nation. And they basically decided, okay, we'll try and make that really, really simple. We'll have somebody establish a new account, but we need them to have something else, something that they don't currently have. So they've got this new relationship that is going to be, at that point, seated or based in a local community or credit union institution within very specific areas. And we want them to establish an account or a relationship there and then use their phone and something that we've added to their phone in order, a sticker, in fact, in order to conduct the payment. Well, the problem is that issuing new cards, issuing new accounts is actually relatively hard. There's roughly, and with all due apologies to my Canadian friends, this is all U.S. numbers, and I'm happy to provide you with the references to each element of the data here. Sourcing would have taken up half the page, so I left it off, but happy to provide that for those of you that want to geek out with me on this. But there's about 1.7 million cards, according to the Federal Reserve Bank of Boston, in the U.S. marketplace. They turn over at about 14% per year, and the top 5 vendors, and these are issuers obviously, control about 42% of the marketplace. So what we wanted to understand was, okay, if I wanted to see a major change in this marketplace and they needed to change something about people having a card or account, roughly, and you can think about this from sort of this radioactive sense, or you can think about it in just purely the run rates, train leaves Boston, train leaves Chicago kind of stuff from your school days. How long would it take for you to change 50% of the market? And I'm presuming here that 3 of your top 5 vendors, so if you get 3 of them to agree on something, how long would it take 3 of the big 5 in whichever one of these areas working in concert to get 50% of the market to a certain spot? And it's interesting, one of the hardest ones to change, and the bankers in the audience know this very, very well, is how do you change that relationship? How do you change that financial relationship? It would take a very, very long time to get 50% of the market share to change in any specific direction. And I won't elaborate for each one of these going through, but you can see that the challenge becomes, if we want to change something substantial, really the only easy thing, quote unquote, to change is the phone, and even that takes about 3.5 years for us to see a major market share shift. So that really starts to paint the picture, we believe, that in order for mobile payments to really take off, you have to take this position that says, I'm going to use the ecosystem and I'm going to use the infrastructure as it sits, rather than trying to substantially interact with this environment in a new and completely different way. So what do you have to have? So that's what you shouldn't do. What should you do? What is the actual necessary ingredient to make mobile payments happen? And we think that it's actually boiling down to this relatively simple construct, which is 2 payments loops. In other words, take a payment that we normally see as presenting an account in a store for a transaction, swiping a card, providing those details perhaps in some other way, and turn that around and make that 2 different transactions. One transaction to go get money from an account that we want to leave secure. That's what we've been talking about today. We'll talk about some more. But then the second transaction, the one that's going to be, if you will, in the clear, is going to be exposed, that we want to be a separate type of transaction. In fact, that separate type of transaction could be a virtual currency on either side. We could have a virtual currency funding source, or we could have a virtual currency presentment source. And we think, actually, if you look out at the marketplace, most of the existing examples of mobile payments that have real traction represent this model. And obviously, that's why we would choose to present it to you this way. So if we think about Starbucks, right, they clearly have the most volume in the mobile payment space today. Their funding loop is actually a card that's on file that's acquired, card not present. And from their perspective, when they go acquire funds from your whichever registered card you happen to have, I'll pick on American Express just briefly. If you've placed your American Express card inside that wallet, then when they want to refund or replenish the amount that you're able to spend using the app through the Starbucks entity, then they're going to go hit that for $50, $100, $75, $25, whatever you've set up in your settings in that application. That then is presented in store. When you go to the store and you press the I'm ready to pay now button, you probably are all aware of this, you're actually presenting a gift card. So you're replenishing a gift card, which is the form of tender that you're actually seeing in the store. And that translation from an American Express card that's used for authentication, used for authorization, captured, and is the form of settlement, to a gift card, which is the thing that's used in store and conducts the transaction for purchase, we think is the critical understanding you need to make mobile payments happen. And there's actually several dimensions along which that can happen. We can have alternative sources of currency, precisely as we've just talked about. That could be something sort of fantabulous, like Bitcoin, something really interesting, brand new, and different, or that could be something that you may not have thought of as a currency, and we've already discussed today. It could be loyalty points. It could be reward points. It could be offer funds that a brand is making available in order to better know their consumer customers. On the presentation side, there's several other things that have to happen, right? We've got to be able to do something at the point of sale we'll understand, and we have to be able to integrate with the cash register. So we need to know about the receipt, and we need to know that these, in fact, are good funds. So what is working now? I mentioned briefly how Starbucks works, and that really looks like that top line there. We believe that gift card presentment is really, really interesting. In fact, I'd throw it out to you that gift cards, in some respect, represent the first virtual currency that most merchants accept today, and certainly the largest ones do. The presentment mode, whether or not I'm doing this with a barcode, whether or not I'm doing this with BLE or Bluetooth 4.0 or some other cool stuff related to Bluetooth, it doesn't particularly matter. NFC certainly can be in play here. NFC is a protocol. It doesn't need to be any particular kind of card. And in particular, if we're thinking about HCE, that's an interesting way for us to deliver a card, regardless of what kind it is, regardless of what tender type it is, into that environment. And finally, and I want to point this out, there are a lot of environments where simply telling the cashier what your card number is still a widely accepted mode of presenting payment. So we can think in terms of funding loops coming from a number of different places, direct from the checking account. We've seen Dwala be an upstart in this area. PayPal's done this for a long time. We can actually issue credit specific to the transaction. We've announced a partnership with Alliance Data Systems we're very excited about. We see a number of merchants rethinking their proprietary payments environment from end to end. From the presentment loop perspective, so what is in fact the store accepting? Well, certainly we could start off with a proprietary product on the gift card front. We could also look at a proprietary card number on the credit or through a special network relationship, and that's exactly what MCX has announced that they're doing with FIS through the NICE network. And clearly, of course, almost all merchants today accept the various association cards. And really that becomes a discussion around choice for the merchant. So for the last slide, and I will wrap up here very briefly, what we really need to be focused on with respect to mobile payments is not actually how to enable them. It's not about this infrastructure. It's not about the technology, as much as that really does excite me personally, and I'd love to talk to you about it all day, every day. I do think that what you need to focus on is offers, deals, rewards, gifts, manners in which consumers can receive value. And I think there's an analogy, and I'll close with this point. The analogy is if we look back to the beginning of different forms of media, if we look back to the beginning of television, it really generated or spawned this whole notion of brands sponsoring television programs. Soap operas might be a good example. And the way that the consuming public thought about different brands' products, like soap, changed radically. The way the consuming public purchased them changed radically. The notion of a national brand became possible. As we move forward from, let's say, mid-century, mid-20th century, to the end of the 20th century and the beginning of this one, then we saw, obviously, the growth of an online business. And that entire environment said, okay, well, now I'm not interested in having a brand or an advertiser or sponsor pay for a television program. Now I want them to sponsor a free service that I'm going to enjoy, like searching the internet or accessing videos that people put up about their cats and other things. We want to support this free service in the form of what Google does, what all these other great online players do, and do that in the context of connecting a brand or an advertiser or a sponsor to their consumer customer in a completely different way. And the mechanisms for that are very, very different from what we saw in the television environment. So in fact, our key interest and the key focus that we have at Modo is finding those economic experiences that are relevant for the mobile world. How can we help sponsors, brands, advertisers connect with their consumer customers and enable them to create new experiences that are unique to the mobile environment? And in order to do that, we think the critical tools that are required are a completely different sense of what the currencies that may be in use are, whether they're virtual, sort of far out there, crazy currencies like Bitcoin, or whether they're much more, if you will, pedestrian, everyday, common, and ready-to-use currencies like gift card products, loyalty products, and rewards products. The issue is still the same. How can we create new experiences along these dimensions whereby consumers get more value for free than they did before, and that's delivered safely and securely to their phone? So with that, I will hand it back over for our poll question.
Great. Thank you very much, Bruce, and of course to all the presenters. And we are entering the Q&A session, but first the poll question is popping up here, as I promised at the start that it would. And how well does your current solution set meet your needs in terms of business security, assurance, and customer experience? So if everyone could just take a moment to weigh in on that while we're going through the Q&A, I would be grateful. And let's see, why don't we just jump right into it here? And let me ask, I think I don't always know who to direct these questions to when they come in from the audience, so if you fellows will just indulge me, I'll read out the question and just please jump in. Don't be shy if you want to take it, and if often a question is something that more than one person wants to address, so we can do it that way too. The first question is, do you view the IRS ruling on Bitcoin in a negative or positive light as it relates to the currency's future? All right. Don't be shy.
So this is Michael Tang.
Yeah.
So I'll start and let others jump in. So I think that the ruling on Bitcoin as classifying it as an asset, and whether people believe it's a commodity or a currency, I think that positive or negative, I think, is probably not the right way to ask it, because I think that in order for it to actually qualify as a currency, there needs to be wide acceptance for it. And I think that when there is wide acceptance for it, if and when that actually happens, it will naturally qualify it as a currency. But right now, that's just not the case. And so it's very difficult for people to actually imagine it as a currency.
It's Mark Brule speaking, and I guess I would agree with Michael that I'm not sure you want to characterize it as either positive or negative, but certainly regulators are paying attention to the advent of virtual currencies or cryptocurrencies. And quite frankly, I think many of them are still trying to figure this out. So a number of them have taken positions, and as Michael had said, the IRS is looking at it as an asset as opposed to a currency. Although in the articles that I saw, they did express their views around how people should be looking at it when it is used as a currency in a transaction, and of course coming at it from a tax perspective. But I think, as well, I've heard and read where these regulators the reason they are paying attention to this, because it is getting some traction. I think there's a belief out there that it is bringing some cost efficiencies, or could bring some cost efficiencies to trade and commerce, and therefore it's worth their while to try to get to the bottom of how these would work and fit into the systems we have today. So from that perspective, maybe that is positive.
Great, thank you. Thank you both. All right, next question here. Maybe this is for Vishram. Can an IPT chip be embedded to existing IT systems?
Yeah, so IPT chip does not need to be retrofitted into an IT system because IPT has been shipping in all core-enabled PCs as of 2012. It's also shipping now, from this year in Intel's Core as well as Atom tablets and phones. So if you're looking at a PC that is purchased by IT, most likely it already has IPT built in. But you cannot take an IPT chip and retrofit that into an older machine.
Gotcha. Okay, good. And do you foresee a rise in the use of biometrics to authenticate users online, piggybacking off of the fingerprint scanners and facial and vocal recognition software that is already built into leading smartphones?
So my take here, this is Vishram Gadvi, right? My take here is there is no one single solution that's going to be usable in the market, whether it is biometrics, fingerprint or voice, or whether it is smart cards or IPT. They will all exist and they will all be adopted in different regions of the world depending on the specific usages. Biometrics is still quite unique and quite new. Therefore, the adoption remains to be seen. The other challenge that may happen in the case of biometrics is if somebody steals my smart card, I can always get a new one, or I can change my password. If somebody steals my biometrics, right, I can't change my face or my voice or my finger. So how you go about deploying biometrics and protecting the credentials in the cloud is going to be vitally important.
I see. Thank you. Let's see. Lots of good questions sort of scrolling in here from the audience. Another one, what about countries with developed banking systems but horrible currency controls, corruption, kidnapping, and extortion risks? How does all this apply?
It's Mark speaking. Since I brought up the developing country topic, I can take a first shot at it. Well, I think back to what I was saying in terms of there are problems, and virtual currencies do bring some solutions to those problems that are in those countries. And in fact, cash is still very much king in those countries. But if you picture the countries with, as I said, harsh environments, the lack of banking infrastructure. So you can't, like in a developed world, walk down the street and find your banking branch and be able to do your ATM transactions or whatever. But people do travel miles on foot or in vehicles to make payments. The other challenge or problem in those countries is typically called leakage. When you deal with cash, and as an example, there's payments that move from a government to an individual. Many times there's significant leakage in the value of the transaction by the time it gets to the individual. I was at a conference a while ago where someone indicated that, as an example, in India, that's a $10 billion problem. So whereas if you had virtual currencies and moved values electronically between people, you solve one of those problems. So I think there's certainly applicability for virtual or crypto-type currencies in these developing worlds, and I know that many organizations are looking at how they might apply this technology to those environments.
Great. Thank you, Mark. And here is one for Vishram. What makes Intel's approach different from alternatives like hardware tokens or SMS OPT?
So it really depends on what are you trying to do and what customer base you're trying to go after. So if you have a customer who needs to log on from any random PC anywhere in the world anytime, then clearly having a discrete, one-time password token is the only way to go, right? But if you are looking at, most of the users, most of the time, they log in from the same devices, whether it's a PC or a tablet, or maybe the same one or two devices, onto the service repeatedly. And in that case, what IPT allows you to do is to have the authentication built into your device itself, be used instead of an SMS token or a hardware token. And that is easier for users to use because it can be transparent, and it is also cheaper than SMS token. So at the end of the day, it really depends on the usage, but what we are trying to go after is to find the right balance between having higher level security with the hardware having a lower cost of manufacturing and provisioning, as in the case of hardware token, and having a lower operating cost than SMS token.
Excellent. Thank you. Thank you. And here's one for Bruce. Let's share this question with the audience. Is Amazon a tech giant or a merchant?
And I did respond to that question. That's a fabulous question, and it's interesting when you sit and chat with both the largest of the large retailers and the largest of the large tech giants, which we've had the privilege of doing. They're both putting Amazon up at the top of their bulletin board that they throw darts at. So I would say that what's interesting about what Amazon has done is they are taking all comers on. They are trying to achieve scale in both sort of the tech audience eyeball aggregation, sort of Web 1.0, 2.0 sense, and they are also trying to achieve scale in physical distribution of actually putting stuff in your hands, taking on Walmart and Target directly. So it's exceptionally bold, and Mr. Bezos clearly has a track record of extraordinary success. Whether or not they can continue basically to aggravate Google and eBay at the same level, and Microsoft to some degree, at the same level that they aggravate Walmart and Target and be successful with that certainly remains to be seen. But I think both they and their competitors would clearly identify them as both.
Gotcha. Great question. Okay. And here, Vishram, is IPT being used with the Rogers mobile wallet solution?
So I'm not aware of IPT being in use with Rogers Mobile because there are two things that need to happen. First of all, Rogers needs to be supporting phones which have Intel's chip in there, and it needs to have a payment solution that's using Intel's technology. And as far as I know, that is not the case.
Gotcha. Okay. And let's see, Bruce. Let's see. Is this question for you? Yeah. How is this loop different from the EBPP?
Yeah, another one that's kind of interesting, and I don't want to spend too much time on this. Critical differences between electronic bill payment presentment, which is what EBP stands for, are first of all that there's a bill presented, right? That there's some sort of ongoing relationship. And generally speaking, those folks, for instance, your phone carrier, your electric bill provider, your insurance carrier, your credit card company, whomever, they know who you are. Very, very distinct from when you walk into your local merchant and purchase something. So that's one major difference in terms of how this all works. From a sort of payments geekery perspective, most EBPP, it's a little different in Canada than it is in the U.S., really runs on special purpose forms of the clearinghouse networks, ACH in the U.S., and then there's some super cool stuff that the Canadian market has that the U.S. has not yet caught up with. But the notion is that net settlement process happens kind of behind the scenes with the big engines that the banks share in the infrastructure costs on, and so it's really handled inside baseball in a completely different way than anything that happens in terms of direct to consumer. Now, last comment is people have tried to figure out a way over and over and over again how to use those rails for in-store purchases and online purchases as well, and to date have not really been very successful with that. So the advent of somebody like PayPal is precisely representative of those initiatives having failed in the past. And why that is. Why would somebody prefer to use PayPal than use their bank in order to conduct a very, very similar under-the-covers transaction? Heaven only knows. Consumers do funny things. So that's kind of the quick and dirty on EBPP. It's just kind of a separate thing and hasn't yet gotten connected to this whole merchandising and merchant-centric commerce.
Understood. All right. Let's try to get one more question here. We're right at the top of the hour, but question I think a lot of people think about when it comes to digital, virtual currencies: loss of value through theft or fraud. Who is responsible? Consumer, merchant, or currency depository? Bruce, you want to take that one?
Can you give me one more shot at it?
Oh, sure. Loss of value through theft or fraud. Who is responsible?
Yes, I'm sorry. Yeah, in fact, I responded to that question. So entirely depends on the currency, and quite honestly, one of the things that merchants are super agitated about with respect to this whole interchange thing is exactly this point of aggregation, right? So generally speaking, buyers don't like bundling. They don't like getting features they don't want and having to pay for them. So who's responsible for loss and fraud is something that really is all bundled into current interchange models with all cards, and on the debit card front in particular, that's where the agitation is highest. And so each currency, for instance, gift cards don't have anything. It's caveat emptor. The buyer has to figure that out. If you're using an association product, like a Visa card or MasterCard, et cetera, then those all have very, very specific rules. It's very, very high touch, and generally speaking, the merchant's on the hook, and then sometimes the bank's on the hook. And it depends on how the sequence of transaction works. However, the interesting opportunity is that you could blend these things. And to some degree, that's what I would argue MCX has done. What they have done is they've done a special proprietary relationship, which they've announced, with the NICE network, a part of FIS, and they are basically going through and rejiggering those rules to say who's responsible for what when, and in particular, determining when does a merchant want to self-insure, when does a merchant just want to accept fraud loss, when does a merchant want to push that off on a bank and pay for it. And as with anyone purchasing insurance, it really, really does depend on what you're insuring, what your scale is, and what your loss experience is as to whether or not you view that insurance as a good deal or a bad deal. And very, very large merchants are basically almost universally saying, we view that it's a bad deal. We want out of this deal, and we want you to unbundle precisely these issues, precisely who's on the hook for fraud and theft and other forms of loss. And we, the big merchants in particular, want to self-insure, and you've bundled this stuff together and are charging us universally for it. We don't want you to do that anymore. So I would argue this is a seminal issue for precisely this adoption of currencies, especially if you accept the panel's expanded definition of a currency to be more than just our dear, beloved friends at Bitcoin.
Wonderful. Thank you. Thank you. Another good question. All right. Well, so this we are just a couple minutes past top of the hour, and as we also said at the start, we want to respect everyone's time, so we don't want to go too far past, and we really appreciate everyone participating with us today. I'd like to thank our presenters, Michael, Mark, Vishram, and Bruce. This is a very, very interesting hour of discussion and Q&A. Of course, thanks to the audience. We could not do it without you. You make it all worthwhile. And just to let everyone know in the audience that you will be receiving an email with a link to the presentation. So please look out for that and view the slides at your leisure in the future. And with that, I will wrap it up. Wish everyone a wonderful day, and I hope that you will join us again here very soon. Thank you.